Welcome back to the Deep Dive. Today we're tackling, well, a really fundamental question in finance, isn't it? That age-old debate. Is it better to borrow money, or should you be the one lending it out?
Yeah, it's huge. And this isn't just about, what interest rates are doing right now in 2025. It's more about a lifelong approach. How do you handle risk? How do you want to build wealth?
Right.
So we've dug into a whole range of sources. We've got the big financial gurus, some cutting edge crypto stuff, even looked at how different cultures approach this. The idea is to give you that sort of evergreen knowledge.
Exactly. That's the mission for this deep dive. Help you figure out the dynamics so you can actually strategize, not just, save pennies. So let's set the stage. Borrowing, pretty straightforward, right? You get cash now, promise to pay back later, plus interest. It definitely opens doors, multiplies opportunities. But, and this is the big but.
It multiplies the risks too, big time.
And lending.
That's the flip side. You're providing the cash. You get the interest as your reward. That's your path to, potentially more passive income, maybe less direct risk exposure.
And the one rule that kind of sits above both, it's always about cash flow, isn't it?
Always. Success really just boils down to making sure more money is coming in than going out, consistently.
Now, for someone who's already tracking their finances, the real insight isn't just knowing your net worth, assets minus liabilities. It's using that number almost like a financial thermostat.
That's a good way to put it. Yeah. When your net worth is climbing steadily, maybe that's the signal to think about borrowing for growth, strategically, of course.
And if things feel a bit tighter,
then maybe you lean more towards the stability of lending. Protect what you have, generate some income.
Okay, let's dive into borrowing first. It feels like the double-edged sword people talk about.
It really is. Borrowing gets such a mixed press. You've got people like Robert Kiyosaki basically saying, hey, there's good debt. Use it to buy assets that make you money.
The whole rich dad philosophy.
Right. And then you swing completely the other way to someone like Dave Ramsey, who's shouting from the rooftops that almost all debt is just a trap. It'll ruin you.
So Kiyosaki sees rocket fuel, Ramsey sees quicksand. Where's the actual line for most people? How do you use that leverage without, crashing and burning?
The line really comes down to the return on investment. It's simple arbitrage, fundamentally. Can you borrow money at, say, 5%?
Okay.
And then reliably invest that same money somewhere it's going to earn you more, maybe 10%, maybe more. If you can do that consistently,
then the debt pays for itself.
Exactly. You're not really paying interest in that case. You're sort of renting capital that's making you even more money.
Right.
It's using OPM, other people's money, the bank's money, to build your wealth, not just draining your savings.
Which is precisely Kiyosaki's whole model, right? That famous $1.2 billion debt portfolio. Almost all in real estate that generates cash flow month after month. And people are still doing that. You see smart investors using current mortgage rates, what are they, around 6-7% now in 2025?
Yeah, around there.
Using those rates to refinance or buy rental properties where the income covers the cost.
And there's another angle too. Responsible borrowing actually builds your access to more capital later. It helps your credit score.
Right, the score is key.
Yeah, it unlocks better rates when you really need them. We saw sources pointing out that even student loans, and gosh, the average balance is huge now, like $56,000.
Wow.
Even those are often framed as good debt, or at least necessary debt, because that degree could boost your lifetime earnings by 20 or 30%, potentially.
And don't forget the tax side. That's a perk people often overlook.
Definitely. The interest you pay on things like mortgages or business loans, often tax deductible.
So the real cost of borrowing is actually lower than the sticker price. Even someone like Warren Buffett, who's pretty conservative about debt, gets the value of using it smartly to amplify returns.
But let's flip to the dark side, because it's genuinely scary. If good debt is rocket fuel, bad debt is like pouring gasoline on a fire you're standing in.
You mean high interest stuff?
Exactly. We're talking 20% APR credit cards. That interest compounds against you ferociously. The amount of revolving credit card debt in the US, I saw a figure, $645 billion. It's staggering.
Yeah.
That number alone shows you why Ramsey calls it a trap.
And that's just the debt itself. What about external shocks, like losing your job or the market tanking?
Well, that's the over-leverage risk. We saw it crystal clear in 2008. People borrowed up to their eyeballs, had no cushion, and when the market turned, they lost everything.
Terrible. And the stress.
Oh, the psychological toll is immense. Chronic debt stress literally raises your cortisol levels. And borrowing from family, research suggests it strains those relationships something like 40% of the time if repayment goes wrong.
Okay, so summing up borrowing, when does it really make sense?
Generally, it seems best suited for, let's say, entrepreneurs or investors, maybe under 40, who have a stable income stream already, and specifically for buying assets that are likely to grow in value or produce income, like education or real estate.
And if you're already in debt,
Yeah.
what's the playbook?
You need an exit strategy. There are basically two popular methods. The debt snowball.
Pay off the smallest ones first for motivation.
Yeah, get those quick wins, build momentum. Or there's the debt avalanche. You target the debt with the highest interest rate first. Mathematically, that saves you the most money.
Makes sense.
But the absolute rule, keep your total debt payments below 36% of your gross income. That debt to income ratio is critical, non-negotiable, really.
Got it. Any advanced moves for borrowers?
Well, things are getting interesting with crypto finance, though it's risky. Platforms like Aave let you deposit crypto assets and then borrow against them, often at really low rates, like 1-5%.
While your original assets are still potentially earning something.
Exactly. They can still earn yield. It's powerful leverage, but, and this is a huge, but crypto is volatile. If the value of your collateral drops suddenly, boom, you can get liquidated, lose it all. So you absolutely have to understand the risks.
Okay, huge risks there.
Yeah.
Let's switch gears completely. Lending, being the bank.
Right. Now you're on the other side of the table. You're essentially becoming the house, as they say in Vegas.
Taking less direct risk, maybe. Collecting the interest from others, taking chances.
That's the idea. You're collecting the interest on their ventures. The big upside is obviously a steady income stream, hopefully passive.
Like peer-to-peer lending.
Yeah, P2P platforms can offer decent yields, maybe 4% to 8%. It's also a way to diversify your investments away from just stocks and bonds.
And it's not just small players. Big institutions are heavily into lending now too, right?
Oh, yeah. Huge private equity firms like KKR, they're setting up massive funds, hundreds of millions, just for direct lending to businesses they're aiming for and often getting returns over 10%.
And as the lender, you call the shots.
You set the terms, absolutely. And crucially, you can demand collateral security against the loan, like property deeds or other assets. That dramatically reduces your downside if the borrower can't pay.
Okay, what about inflation? Does lending help there?
It can, yeah, if you structure it right. A fixed rate loan can help protect your purchasing power if you lock in a decent rate. Or you could use variable rate loans where the interest adjusts, helping you keep pace if prices are rising quickly.
But it can't all be smooth sailing. Lending feels like it hinges entirely on trust.
That's the weak link, absolutely. Default risk is the #1 headache. The borrower just stops paying or ghosts you.
Especially tricky with family or friends, I imagine.
Huge potential for fallout there. Money Helper explicitly warns about it. Lending can really damage relationships if it's not paid back. And even on P2P platforms, data shows maybe 40% of loans face delays. That messes up your expected cash flow.
And there's opportunity cost too, isn't there?
For sure. If your money is tied up in a loan earning, say, 5%, you're missing out on whatever the stock market might be doing historically. That's been more like 7-10% annual returns, though, with more volatility, of course.
Plus, if someone does default, chasing them for the money.
Yeah. Legal hassles. It takes time, costs money, and there's no guarantee you'll get it back.
So when is lending the clear winner? Who benefits most?
It tends to appeal more to savers who are naturally risk-averse. Maybe people closer to retirement, over 50 perhaps, who prioritize stability and preserving the capital they have.
So things like CDs or high-quality bonds?
Exactly. Stuff where you get a predictable, reliable yield, maybe 4 or 5%, without too much drama.
What if someone's new to this, wants to dip their toe in lending?
You don't have to start by lending thousands. There are micro-lending platforms. Kiva is a well-known one. Often these are 0% interest loans, more focused on social impacts. But it lets you learn the ropes, how to assess risk, how the process works without putting significant cash on the line. It's like training wheels for lending.
Okay. And for the really advanced tech-savvy crowd, you mentioned something earlier, looping.
Yeah, collateral looping. This is deep in the weeds of decentralized finance or DeFi. Highly advanced, definitely carries significant risk.
How does it work, basically?
You're essentially taking that idea of borrowing against collateral, but automating it. You deposit stable coins, cryptos, pegged to the dollar into a protocol, borrow against them, take the borrowed funds, redeposit them.
Whoa, okay. compounding it.
Exactly. You're leveraging up multiple times automatically to try and maximize the yield. People talk about seeing APYs, annual yields, at like 30% in some of these automated strategies or vaults.
But the risk must be equally high.
Oh, absolutely. If the underlying protocols have bugs or if there are sudden market shifts, you can lose everything very, very quickly. It requires serious technical understanding and risk management, not for the faint of heart.
Right. Okay, let's try and bring these threads together. We have these big clashing philosophies.
We really do. Let's recap the main players. You've got Kiyosaki, the bull, saying, debt is awesome leverage. Borrow big, but only if the asset makes more than the loan costs. He's all about good debt for income.
Then Ramsey, the bear. Debt is dumb. Pay cash for everything. His focus is purely on security, peace of mind, especially for families. He basically thinks Kiyosaki's approach is just gambling for rich people.
Pretty much. And then there's Buffett, sort of the wise owl in the middle. He avoids too much debt, loves having cash on hand.
Right, the famous cash hoard.
But he definitely understands using debt strategically when the numbers make sense. His big warnings are against excessive leverage and those high-interest debt traps, like credit cards.
It's interesting how we see these dynamics play out, even in movies.
Totally. Think about Margin Call. That film perfectly captures the sheer terror of being over-leveraged when the market turns against you. Borrowing on margin, it can wipe you out overnight.
And The Big Short, that was all about leverage too, but used differently.
Exactly. They weren't borrowing to buy assets. They were using complex financial instruments, essentially borrowed positions, to bet against all the bad debt piling up in the system. The lesson there: learn to spot those bubbles of bad debt before they pop.
And on the lending side, any cautionary tales from Hollywood?
Well, there's that Indian film from 2023, Lucky Bhaskar. It apparently showed the really dark side of predatory lending, the moral damage, the ruined lives. It echoes that warning about lending to family, too, which always is this really understand the emotional cost. Is it a loan you expect back, or is it just a gift you need to accept, might not return?
It seems the smartest approaches often mix both borrowing and lending. You mentioned something about community banks in Kenya.
Yeah, SACCOs, savings and credit cooperative societies, they're fascinating. Members pool their savings, essentially lending to the cooperative.
Okay.
And then the SACCO might borrow larger amounts externally. Then it lends that money back out to its members, often at good rates, for things like starting a small farm or business. It's a blend of both sides, working for the community.
So how can someone listening try to master both sides? Any advanced tactics?
Well, one strategy is the hybrid approach. Look for opportunities to borrow cheaply, maybe a low-interest government loan or promotional rate, and then find a way to lend that capital out at a higher safe rate. Perhaps structuring a well-secured P2P loan at, say, 12%. You're capturing the spread.
And for those tricky family loans, how to do them right?
Protect the relationship above all else. Use a proper promissory note, write down the terms, the interest, the repayment schedule.
Make it official.
Exactly. And the Consumer Financial Protection Bureau actually suggests talking through the what-if scenarios up front. What happens if you lose your job? What if I need the money back early? Get it all out in the open before any money changes hands.
That seems smart. What about dealing with inflation right now?
That's a big one. The general play, if you can manage it, is maybe borrow at a fixed rate now, especially for long-term debt like a mortgage. Inflation over time will erode the real value of that debt you have to repay.
Okay.
But on the lending side, you might want to use variable rates or keep the loan terms shorter so your returns aren't totally eaten away by rising prices. You want your lending income to keep pace.
All right, let's wrap this up. We've covered a lot of ground. What's the final verdict? Borrow or lend?
You know, predictably, there's no single right answer. It really boils down to your age, your goals, how much risk you can stomach.
So maybe younger people chasing growth might lean towards borrowing.
Generally, yeah. If you've got a high risk tolerance, a long time horizon to recover from any mistakes, strategic borrowing can be that rocket fuel we talked about.
And for those prioritizing security, maybe closer to retirement.
Lending probably feels more comfortable. Capital preservation, steady income, sleeping well at night, that's often the priority then. Lending provides that stable foundation.
But the real masters?
The real financial winners usually figure out how to use both tools effectively. They borrow strategically to grab opportunities and build assets. And they set up lending streams, whether it's bonds, P2P, or something else, as that reliable autopilot income for the long haul.
It sounds like it requires a real mindset shift, moving away from just saving.
Exactly. Moving from that scarcity mindset, Kiyosaki's poor dad saved every penny, towards more of an abundance or investor mindset. Rich dad invested in things that produced income.
So for everyone listening, what's one action they could take, like today?
Start simple. Audit your current finances. Where are you borrowing now? What are the rates? Can you eliminate any high-interest debt immediately? That's often the biggest win.
Or on the flip side?
If you have some extra cash, maybe explore lending. Start small. Look into a micro-lending app just to understand the mechanics. Dip your toe in the water.
Okay, final thought. Something to leave people chewing on.
I think it comes down to stress testing your own situation. Before you take on a big new loan or before you tie up a lot of capital lending it out, run a simulation. Ask yourself, what if my income suddenly dropped by 20%?
Oof.
Could I still handle my debt payments? Would my lending portfolio be okay? If you can withstand that kind of hypothetical shock, you're probably in a pretty resilient position. Financial freedom ultimately isn't really about luck. It's about making disciplined choices, and that starts with being prepared.